This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. This is the Definitely Uncertain podcast, and my name is Darren Rockman, and I'm a partner at Gold Rock, the more than 20-year-old multifamily office servicing high net worth families in Israel and around the world. Over the last decade and a half, really since the 2008 crisis, one asset class has grown and matured in ways that I don't think anybody had expected, and that is the world of private debt. And that happened during a market where interest rates were low and kept going lower all the way down to zero. And investors were looking for a place to put their money to make a return. And private debt became that area. The world has changed and now interest rates are much higher. And so to discuss what private debt is, what the risks are, and how this operates in the new world of high interest rates in which we now live, I'm very pleased to welcome Jason Smilovitz. Hey, Jason, welcome to the podcast.
Hey, Darren. Thanks for having me on.
Thanks for joining. Jason is a seasoned professional in the structured credit industry. He's been doing this type of work for more than almost 20 years, since 2005. He started his career as a consultant in Deloitte's securitization practice, and he has been involved in innovative solutions across asset-backed securities, CLOs, and other alphabet soup things that most people don't know about, but Jason is absolutely an expert. He's walked through a number of down cycles, including the great financial crisis and COVID-19, and seen the impact of that on the private credit industry. And today he advises some major financial institutions and individual investors. He's an independent consultant, and we're really pleased and honored to have him on the podcast.
Thanks.
Jason, let's start with the following. Investors who have been considering this area of private credit, explain to us what that is and what are some of the options, because there are many types of private credit that they could be investing in.
That's right. There are many different forms of private credit. It's a very generic and general term. But I would say since 2010, post the GFC and the Dodd-Frank regulations, private credit is itself its own asset class. But when you're talking about consumer credit or private credit, it could mean consumer credit, it could mean corporate credit, and it spans many different areas. On the consumer side, you can consider credit cards, auto loans, personal loans, or BNPL, buy now, pay later, and mortgages. Those are forms of consumer credit. On the corporate side or the commercial side, you've got the commercial real estate, you've got small and medium business loans, and then you've got the bigger components, which are the bank loans, like broadly syndicated loans or leveraged loans that are issued for the sake of private equity deals, for example, or just for working capital in the case of private industries. But when you start talking about private credit today, to me, that is its own asset class, which can be linked to some of those other types of lending products. For me, I break it down into structured credit and private credit. Structured credit would be credit-linked investments like asset-backed securities that are backed by some of those consumer or those corporate loans. You've got RMBS or CMBS, the residential and the commercial mortgage-backed securities, CLOs, which is a favorite of mine. And then you've got the credit funds. And the credit funds are the hottest asset class right now.
Okay. So I'm going to take a step back. Once upon a time, if you wanted to borrow money, you really had two options. You went to the bank and you got a bank loan, or alternatively, you went to the bond market and you issued a bond, and then people could then buy that bond and subscribe to that bond and then effectively lend you money through the public markets. And private credit, after 2008, 2010, came to fill a gap because the bond market sort of seized up for a while, and the banks were regulated to the hilt so that they couldn't make a lot of the types of loans that they used to make, leaving this demand on behalf of borrowers for credit, and that's where these things came in. So Um, why was the investor market keen on investment? You know, on these credit linked investments, on these private credit investments, and is that still the case? Is there still that same interest and demand for these types of securities, which you rightly say are effectively now their own asset class?
I mean, the reason this came about was because the banks tightened their lending standards after the GFC, and we're seeing that again now in the current downturn. And so these private funds, now we call them private credit funds, they stepped in to fill that gap in the market. And essentially it helps the general economy because otherwise you have businesses that are unable to borrow and
Yep.
unable to capitalize their businesses as needed. And because they are not coming as non-bank loans, they come with a bit of a risk premium. Because if you could have gone to the bank, which has tightened their lending standards and therefore has a tighter spread of what they are going to charge you interest on, you're clearly going to the non-bank lender because you're not qualifying at your regular bank. And so the investors in the private credit funds or in the private credit markets, they're getting a risk premium for backing those funds that are lending out to these borrowers. Not to say that these borrowers are necessarily any riskier than they were before, but it's a different avenue for lending, which comes with a premium. Just
Right.
like bridge financing is more expensive because it's a short-term loan, but it's the same asset that might be backing that bridge finance loan. But when it gets into a mortgage state from a bank, it gets cheaper to finance.
Okay, so if we go back, say 3 or 4 years, okay, somebody buying a corporate bond or putting a deposit at the bank, they were getting a certain percentage, and someone investing in a credit fund was getting a much higher percentage. So what was the difference? What additional return was an investor able to make investing in one of these private credit funds?
If you're talking about numbers, there's a credit spread. I don't hold me to anything, but you're talking about at least 200 basis points.
Two
I would
percent,
expect 2%. Yes, I would expect just because of where you're falling on that risk matrix.
right?
But yeah, you're
So
you're
you were getting
walking.
paid at least 2% more, sometimes 3, 4, 5% more, depending on how much risk you're willing to take.
Yeah, yeah, it could be more than that even.
Yes. Okay. Um, let's dive in a little bit. Let's talk about a couple of the types of credit products that investors were and are investing in.
Sure. So for me, I like to talk about CLOs because that's the that's the guy that's been on the block for a number of cycles. They've been around pre 2008 GFC. They've gone through numerous cycles and they've got some good data to back up their, call it, quality or
Right.
creditworthiness. So
Okay.
you've got
So I want you to explain in simple terms, because it's not so simple to explain, but you're really good, Jason. So say simple terms, what is a CLO?
a CLO is basically a bond that is issued in multiple tranches. So you've got a class A, B, C, D, E, F, and a subordinate referred to as the CLO equity, but it's not really equity, it's still a bond.
Mm-hmm.
And the payments of coupon and principal to the investors of those tranches, those notes, is coming from the cash flows of loans. And a CLO is either made up of commercial real estate loans, if it's a CRE CLO, that's not my expertise, or leverage loans, the leverage loan CLO, which is where I specialize in. And those leverage loans, like I said before, are loans that came about from private equity deals or other working capital type loans,
So
broadly syndicated loans
loans
by
to
banks.
companies. So
Yes.
effectively, this CLO lends to companies. Investors buy pieces in the CLO of different levels of security and then different levels of return internally. So
Yeah. Yeah. So the CLO manager is buying these loans or pieces of the loans. I like to
yep,
use this example here in Israel. You've got Bright Foods that acquired Tnuva, And if I'm not mistaken, there was a $3 billion broadly syndicated loan that was issued by banks, multiple banks, to essentially fund the deal. And that $3 billion gets spliced up amongst other banks, and they trade those loans. And there will be a CLO manager out there that might be holding a piece of that Bright Foods Nuva loan in their CLO that is paying the CLO investors principal and interest, like a bond.
Okay. And so why were investors interested in investing in these CLOs? And is that interest still there? Is it still a compelling investment?
I definitely think it's a compelling investment. And I personally invest in CLOs as well, just for the record. And I would say that the interest is there because it's a good asset class with historically low loss rates. I think it's below 1% for the last 20 years, if I'm not mistaken. And yes, it's being tested again in the current economic downturn, the current economic cycle. But if you understand what a CLO is, you'll understand why it makes sense. And this is why I think it does. You've got a diversified pool of loans. And when I say diversified, that means that you're talking about diversification from industry and you've got diversification from geography. And these loans have payments, interest payments and principal payments by the borrowers that are being paid monthly, quarterly, whatever their payment terms are. And the CLO is paying out to its investors quarterly, usually, the coupon and the principal that is due to the investors. So you've got a pool of hundreds of loans that are funding these bonds and notes. It's just like an ABS, just like an MBS. It's just a different set of assets backing the deal.
Right. Corporate loans. Okay. Now, I want to sort of swing back to the question that I started with. The interest in private credit grew up at a time when there were really no other options if you wanted to earn some type of return on your cash in a safe and secure way. Bank deposits were non-existent. They were offering you less than 1%. Even corporate bonds were only offering you a yield of 2-3%. The world today is very different. You can put money in the bank and earn 4 or 5%. You can buy a corporate bond earning you maybe 5 or 6 or 7%. How does private credit stack up in this new world?
Well, you can't compare private credit to investment grade corporate bonds. It's very different because your investment grade corporate credit is going to be paying you somewhere in that, and correct me if I'm wrong here, 5-6% maybe.
Yep.
So you can be going into a private credit fund that's lending out to its borrowers. And if I'm not mistaken, Goldman Sachs recently reported that some of these loans in the private credit funds are charging 13-14% interest. So you just have a higher rate of interest on these loans that allows the funds to pay out their investors at a higher rate than what you would get in the corporate bond market. And then in terms of CLOs, if you go lower down the capital stack, let's talk double Bs, which is a hot topic right now. They're paying 950 basis points. That's 9.5%, 9 to 9.5% on top of the index rate, which is, as we see, index rates across the world are going up in the 5 to 6% range.
Yep.
So there's just more yield there.
Okay. So what you're saying is that you're getting paid for even today, you're getting paid for the extra risks you're taking. And as interest rates have gone up, the return that you're getting from investments like CLOs has gone up commensurately.
100%. And that's because these are floating rate assets. These are floating rate assets that are backing, in many cases, floating rate debts.
Right. Let's talk a little bit about the other side of the coin, because there ain't no such thing as a free lunch. Although if you ever offer me a free lunch, I'll probably take it.
Vice versa.
What are some of the risks? What are some of the risks associated with investments like CLOs, ABS, asset-backed securities, and those types of things?
Yeah, I mean, you can look at the headlines, and the headlines will give you all the risks because the news loves to yell fire. So
Right.
you've got, corporate downgrades, defaults, lower recovery rates, maturity walls, reinvestment periods, lack of loan availability. There are a number of things out there that you can consider risk factors. But the question is, as it is with anything, how do you manage your risk? And that's what's important when looking at these types of assets for investment purposes.
Let's talk about maturity walls. Okay. For those unfamiliar, a maturity wall is when a lot of debt needs to be refinanced at the same time. And when a debt needs to be refinanced, particularly when the debt was taken at low interest rates and now has to be refinanced at higher interest rates, investors are concerned about the ability of the company to keep going in this higher interest rate environment when they need to suddenly pay a lot more for the money they've borrowed. There is a big maturity wall coming up in 2024 and 2025. What does that mean for this industry? Does that mean we are likely to see significant losses? Does that mean that we're going to see a big spike in bankruptcies? Or does that mean, or maybe, and does that mean there's a huge opportunity for investors?
So I don't think that there is as much to be concerned as the headlines are saying. Companies have debt maturing every day, and they have to refinance that, and they will refinance that. Yes, they will pay more. But if you look at what's going on right now in terms of the payment rates and the different ratios, like for example, with the CLO, you have your interest coverage ratio, which tells you how well they're able to cover the interest payments to
From their
the
profit.
investors. The ratios are still performing. Things are still performing. And you also have to remember that CLOs are not CDOs. Everybody likes to conflate the two. CDOs don't exist anymore. Okay. CDOs, the biggest problem, well, maybe not the biggest, but one of the problems with the CDOs during the great financial crisis was the fact that they had to sell their assets when things went south. CLO doesn't have to sell their assets. They can hold on to it, and they can work with the borrowers to essentially get through the call it a crisis for lack of a better term. So yes, there will be maturities coming, and maybe we can admit that it is a high rate of credits that are going to be maturing. But I think we're all coming around to this idea of 5-6% base rates, because if you think about it, yeah, we did live a very long period of zero interest rates. In fact, a lot of people like to say how some of today's practitioners never even worked in a period where there were positive interest rates. But this isn't the 80s where you had double digit interest rates. Hopefully we won't ever get there again. But I think it's manageable. And I think that maturities will happen in a very clean and calm fashion, and companies will be able to
Jason, you're going to
make
have
their
to stop
payments.
because it seems your internet connection's a bit spotty. Are you
Okay.
there? Okay.
Yeah, I'm here. Can you hear me?
You were starting to say that maturities will happen in a clean and calm fashion. So pick up the sentence from there.
Yeah. So maturities will happen in a clean and calm fashion. And we're already seeing the with the technicals that are happening in the CLO market, they are behaving exactly as we expected them to behave. The structures are performing as the deals were meant to perform. Everything is kicking in and working the way we want them to work. I don't think that we have much to worry about just yet.
Okay. When you combine that with concerns about recession, and in the recession, corporate profits go down, you were talking before about interest rate coverage. Is there enough interest rate coverage in most of the CLOs that you're seeing to withstand a reasonable hit to company profitability given where the interest rates are today?
Well, it depends on where you sit in the capital structure of a CLO. If you are the equity holder at the very bottom of the waterfall, then as soon as the non-call period ends, you're going to want to push the CLO manager to refinance or reset the CLO. And there's numerous reasons for that, but the biggest one is CLO spreads have actually tightened, and month over month, we're seeing better spreads from the top down. And it just helps with your interest coverage ratio, making that equity holder a little bit more profitable on their investment.
Okay. We've been talking so far about the corporate credit market. Let's switch now to the real estate market, which is an area that you also have some insight into. A big part of the loan book of the real estate market has been office, which is a sector that's coming under maybe a generational, maybe a multi-generational stress period. How are the private credit lenders to real estate faring in this new world for office? And what does the next couple of years look like?
So I'll have to just be honest with you. I'm not very tied into the real estate side of the credit space, but you see what's going on in general, which is work from home or remote work is taking on a new life where offices are maybe in use 50% of the time. So you have a smaller footprint in the commercial space. And from what I hear from friends that are in the space, it's a lot harder to get deals done. You've got sponsors out there that are trying to raise money, trying to close deals, and it's just taking longer or not happening. And that's because of the the new face of the corporate world. We don't need multiple floors in buildings. If we had 3 floors in the past, maybe we only need one, 1.5 now because people are working from home half the time. And groups or teams are choosing specific days of when to come in. You know, I don't want to get into it, but the whole WeWork story just came out.
Yeah.
Was it yesterday or 2 days ago now? From when this was recorded. Then okay, WeWork's a huge real estate player all around the world. It's not a good story or a good picture, I would say, in the commercial real estate space. But there are definitely pockets, and that's I think goes for any asset class. There are always going to be pockets. So maybe multifamily is where you might want to look because people will always need a place to live, hang their hat at the end of the day. People who have cash and don't need to finance transactions, those are people who are likely going to be able to close deals a lot easier and faster than someone who has to go and get financing. Are investors making the kind of money they used to make in real estate? From what I hear, they're not. The preferred return used to be 7%, 8% in a great cycle or
Yep.
great part of the cycle. That doesn't exist anymore. 6% is the max that I hear right now.
Right.
So it's softer, just like other alternative asset classes like venture capital or private equity.
It's just going through a rough patch. Let me
Yeah,
let me
but
pick another area, which is consumer loans. Okay, so again, once upon a time, consumer loans were focused on banks, also credit card companies, etc. And then we moved into securitization of these loans, and now these are available as investment vehicles. Everything from peer-to-peer lending all the way up. How is that market faring, and how do you assess the risk reward for investors considering that area of the private credit world?
so that's a very broad question because it's a very broad market. When you say consumer loans, again, credit cards, autos, personal loans, P2P, BNPL, but then you also have the borrowers themselves. You have your tier one versus tier two versus tier three borrowers, tier one being the highest rated FICO scores, tier three being the lowest. And even when you get into specifics within each asset class, you can see a divergence of performance. For example, just this week, there was a chart I saw that showed Consumer credit cards, consumer credit card losses, delinquencies significantly rising. But there was a little note that had a lot of nuance to it that you really had to notice, which was non-bank credit cards.
Mm.
Meaning, when you walk into a department store like Macy's or Best Buy, and they want you to sign up for their credit card. So those retail cards, the losses there, the delinquencies there are rising at a higher rate than the bank credit cards, the cards you would get from your bank, like a Citigroup or a JP Morgan Chase, for example. So certain areas of the consumer credit space are softer than others. P2P, BNPL,
Buy now, pay
I
later.
buy now, pay later. Yeah. I personally, I never loved that space. It's
That
high
makes two of
risk.
us.
I don't want to talk bad about anybody, but Kroll Bond Rating Agency, KBRA, so they maintain an index for personal loan performance. And in July, they reported annualized net losses among the tier two loans at a record of 19.47% for the prior payment
Wow.
period. That means June, almost 20%. And here's the kicker: the majority of those losses, 67% of them, came from two well known names, just two well known names in the P2P personal loan issuance market. Does that mean the whole market is not worth looking at? No, because, and this, I like to look at this one. Mark Okada, the CEO of Sycamore Tree Capital, he came out early in 2023, and he said that this year his money, one of his bets is on AAA ABS. And that's really, I think, how you might want to look at it. If you're looking in the consumer credit space, you want to look at the higher rated tranches, the higher
The
rated
best
pieces.
borrowers, the best borrowers, and the safest pieces.
Exactly. You're not making as much as the guy who's making in his double B CLOs of 14, 15%, but you're making 7%, 8% after index plus spread. And you're talking about prime borrowers and you're talking about prime ABS. Again, securitized products, you've got a large pool of assets that are backing a bond. So you've got diversification. And I think he's right. And to be honest, I've been I've been blown away by the number of issuances I see every single week now coming from prime auto and prime equipment and prime anything in the ABS space. These deals are coming out. They're coming to market with $750 million issuances, getting upsized to a billion plus. There's demand for the high quality credit out there.
Right, right. Which sort of makes sense as people look forward into a potential recession and potential strains in the market. So that's been a really interesting primer on what this private credit market is and some of the pockets in which you've played and maybe some of the pockets where you play less. If you had to give a practical tip to an investor who is interested in going into this market, what would it be?
It's a great question. And
Well,
this may
it took
sound,
all the way to the end of the interview for me to ask a great question, but I got there eventually.
I mean, all good conversations eventually come to the best
The
part.
clincher.
Yeah. I've in thinking about this, I've come up with this phrase, and maybe I'm not the first one to come up with it, but I call it financial Darwinism, survival of the financial fittest. When you're looking at anything, when you look at anything for investment purposes, but specifically in the credit space, in the structured credit and the private credit, you want to make sure that you're looking at the strongest because the strongest will survive. You're talking about the strongest borrowers, the ones that are going to be able to survive this current economic cycle. You want to look at the strongest managers, the ones that have the experience and the knowledge, the acumen and the fortitude to survive the current economic cycle. You hear this a lot where, CLOs, they're not forced sellers. CLO managers are not forced sellers, but sometimes the manager is going to say, you know what, I got to sell this piece of paper. And they go ahead and they sell it and they left money on the table. So you want to look for the managers that have the experience of a couple cycles, that have the knowledge of how to get through the hard times. And like take, for example, private credit. What happens when a private credit deal goes sour? Well, it's a loan and you're first in line during a bankruptcy event to collect, which is why a lot of people do like credit.
Yeah.
And so you've got Blackstone and HPS who are really good in that workout and restructurings. They've got experience there. So just like they've got experience in the structured credit and the private, they've got experience in the bankruptcy and workout as
Yeah.
well. So you want a well-rounded manager, an experienced manager who knows what they're doing, who's gone around the block a couple times, I would say. BNPL, I don't like it, but KKR just bought $40 billion worth of PayPal's BNPL loans. They know something that I don't know, obviously, but you know, I would look at KKR and I would say, okay, that's a manager worth looking at.
Okay. Well, that's fantastic advice, Jason, and really great insight into what is, for some people, a hard market to get their head around. And I think that's really helpful background and helpful insight. So thank you very, very much indeed.
You're very
And
welcome.
we really enjoyed having you on the podcast.
I enjoyed being here and I enjoyed our conversation.
Fantastic. Me too. And for all of the listeners out there, thanks for tuning in. We will have more podcasts coming your way soon. And bye-bye for now.